Hey there. Welcome to Money Nudge. This is where we make money talk simple. Have you ever wondered why your mortgage, your car loan, or even your credit card suddenly gets more expensive? Even though you didn't change anything? That's not your bank. That's your central bank. And today, we're going to talk about how it quietly controls your money without ever touching your wallet. So, what exactly is a central bank? Think of it like the control room of a country's money system. In the US, that's the Federal Reserve, or simply the Fed. Their job is to keep the economy balanced, not too hot, not too cold. When things heat up, prices rise too fast, they try to cool it down. And when the economy slows, they try to warm it back up again. Their main tool for doing all that is called the interest rate. It's basically the price of borrowing money. When the Fed raises rates, borrowing gets more expensive. People and companies slow down spending. When they lower rates, borrowing gets cheaper and the economy speeds up. You can think of interest rates like the volume knob of the economy. Turn it up, people spend more. Turn it down, people hold back. But how does that actually affect you? When the Fed raises rates, your credit card, your car loan, your student loan, all get more expensive. Businesses borrow less, which can mean fewer job openings. But inflation slows down. Things stop getting pricier. On the other hand, when the Fed cuts rates, loans get cheaper and people start spending again. That can help the economy grow. But if it goes too far, it can also reignite inflation. Let's take a real-world example. When COVID hit in 2020, the world basically stopped. To keep the economy alive, the Fed slashed rates to nearly zero. That made borrowing super cheap. So people bought homes, businesses took loans, and the stock market shot up. But then, inflation exploded. The Fed had to slam the brakes. They raised rates faster than in the last 40 years. Mortgage rates jumped from around 3% to over 7%. Housing slowed, borrowing dropped, and prices finally started cooling off. Every move the Fed makes sends a ripple through your life. Your job, your rent, your investments. When rates change, the value of the dollar, stocks, and even gold react almost instantly. That's why investors watch every single speech the Fed gives, because it literally changes how trillions of dollars move around the world. But no, the Fed doesn't steal your money, but it controls the conditions that decide what your money can do. When rates go up, tighten your budget and focus on paying down debt. When rates go down, it might be time to invest or refinance. Understanding this stuff helps you play the money game with your eyes open. Let's do a quick recap. The central bank, like the Fed, controls the flow of money in the economy. Their main tool is the interest rate, the cost of borrowing money. When they raise rates, borrowing slows, inflation cools. When they cut rates, borrowing grows, spending rises, and everything from your job to your rent to your savings feels those ripples. And that's it. Now you know what the central bank is. You just got a money nudge. Hit that subscribe button and we will keep the money talk simple, one video at a time.